Hey, what's up guys? John here. The mortgage market, the housing market, and the job market, they're collapsing right before our eyes. And I think that this collapse is going to give us a once-in-a-lifetime opportunity to build out tremendous wealth for ourselves and our families. Looking at the state of California right now, California has a whopping 1.5 million tenants that are behind on rent. They simply cannot pay or refuse to pay rent in the state. 1.5 million. That is substantial. And right now, they're saying that the housing market records the sharpest decline in almost 20 years. 20 years. U.S. mortgage lenders are starting to go broke and expect layoffs of 51% of U.S. companies. So you look at it this way. You have 51% of companies issuing layoffs. You have mortgage companies that are going broke. You have tenants that simply cannot pay these rent increases. And we have higher utility bills, higher insurance costs. We're seeing very, very dramatic changes that are going to impact the housing market, right? We're seeing very, very big changes. Now, when I'm looking at this mortgage lender situation, I see a situation in which many borrowers are simply not going to be able to obtain financing, and many lenders are going to be very, very careful in who they lend money to, simply because we're going to see a lot of loans going under. We're going to see a lot of borrowers losing their homes. I believe over the last couple of years, people were buying real estate not because they had to get a home, but because they saw, interest rates are 2.5%, 3%, 3.25%. Why not borrow money at that percent and buy a $500,000 house? If the home appreciation is 15 or 20 or 30% a year, which it was in many markets, why not just ride that appreciation by holding real estate? But what happens if home values start to get questioned and pulled back and inflation rises? It means that their equity is getting chewed away at the same rate of inflation. Let me give you an example. Let's say you buy a $500,000 house, you put $100,000 down, 20%, right? You put 20% down, and that home next year is worth $515,000. It appreciates at 3%, like traditional home appreciation. But if inflation is 15%, that $100,000, right, or the $115,000, you now have to factor in all the transfer taxes, real estate fees, and sale costs, plus inflation. So if inflation is 15%, you add up the other 6%, it means that there's a 21% decrease in the equity in that property, right, on year one. And if that continues, it's just going to balloon. What I think is going to happen is we're going to see a lot of people forced to sell their properties because they simply are losing the equity and they need that money to make ends meet because the world's getting more expensive and the job opportunities are fading, right? So U.S. mortgage lenders are starting to go broke. The U.S. mortgage industry is seeing its first lenders go out of business after a sudden spike in lending rates, and the wave of failures that's coming could be the worst since the housing bubble burst about 15 years ago. There's no systematic meltdown coming this time around. Remember, they said the same thing in 2006. They said there's no housing crash. Same thing in 2005. There's no housing crash. This situation, I think, is much bigger than what happened in 2006, 2007, because this is going to impact all industries. Because there hasn't been the same level of lending excesses, and because many of the biggest banks pulled out from the mortgage market after the financial crisis. But the market watchers nonetheless expect a string of bankruptcies broad enough to trigger a spike in layoffs in the industry, and that employs hundreds of thousands of workers and potentially an increase in some lending rates. The housing market employs many more than hundreds of thousands of workers, because we're not factoring in the real estate agents, real estate brokers. We're not factoring in title reps, escrow officers, contractors, real estate developers. All of the industries that are tied to the housing market will be directly and indirectly impacted by this, right? And all of the money that they were making, that they were spending in other industries, will also be, impacted as well. So there's going to be a much bigger and much broader effect on the housing market than what they're stating here. More of the business is now controlled by independent lenders. With mortgage volumes plunging this year, many are struggling to stay afloat. The non-banks are poorly capitalized, says Nancy Wallace, chair of the real estate group at Berkeley Hess, the business school at the University of California, Berkeley. When mortgage market tanks, they are in trouble. In 2004, only about a third of the top 20 lenders for refinancings were independent firms. Last year, 2/3 of the top 20 non-bank lenders, according to the lendingpatterns.com, which analyzes the industry with mortgage lenders. Since 2016, banks have seen their share of market shrink to about a third from about half, according to news and data provided by Insider Market Finance. Many of the so-called shadow lenders will emerge from this slowdown relatively unscathed, but some some lenders have already stopped operating or scaled down dramatically, including Sprout Mortgage and First Guarantee Mortgage Corp., both specializing in riskier lending that isn't eligible for government backing. First Guarantee, a company that according to court papers is majority-owned fixed income giant Pacific Investment Co., and they filed for bankruptcy, saying that it failed after it made loans earlier this year that dropped in value. It was holding onto those loans until it had enough to bundle into bonds to sell to investors, and it had been temporarily funding them with a line of credit. Once interest rates started to climb, lending volumes shrank across the industry according to court papers. That meant the company could no longer find enough new loans to bundle or get enough financing to keep operating, said First Guarantee CEO Aaron Samples. Firms including Flagstar Bank and Customer Bank are owed about $418 million according to court documents. First Guaranteed employed 600 people before it filed bankruptcy in June and made $10.6 billion in loans last year, according to court records. Days before seeking court protection, the company fired 471 workers because it couldn't get enough financing to overcome the cash crunch. Independent lenders gained a toehold in the market because banks pulled back so much after the 2008 financial crisis, which started with excessive lending and mortgages. Regulators have often encouraged the retreat, and it's still happening. Wells Fargo & Co., the biggest Wall Street firms in the U.S. mortgage business, plans to shrink its home loan empire. Unlike banks, independent lenders often don't have enough emergency programs they can tap for financing when things get tough, nor do they have stable deposit funding. They depend on credit lines that tend to be short-term and depend on mortgage prices. So when they're stuck with bad assets, they face margin calls and potentially go under. Many independent lenders have managed their risk well, and for lenders that work extensively with government-backed companies like Fannie and Freddie, the situation is less dire. They can often get emergency funding from government-sponsored enterprises if they run into difficulty, but those lenders that make up riskier loans and work less often with GSEs have fewer options when they face margin calls. Part of the reason that these companies are distressed is because the loans can't go to GSEs for funding, said David Goodson, head of the securitized credit at Voya Investment Management, in a phone interview. The options for funding are more limited, which is especially painful when financial conditions are tightening. Many other lenders have seen the value of their loans drop, said Scott Buchta, head of the fixed income strategy at Breen Capital, an independent investment bank. The Federal Reserve has tightened rates by 2.25% this year in an effort to tame inflation, and 30-year U.S. mortgage rates have surged above 5% for government-backed loans. That's close to the highest level since the financial crisis, from around 3.1% from this year around, right? So you have the mortgage industry changing, but now 51% of U.S. companies are experiencing or expecting to issue layoffs. 51%. We've heard a lot of these big names, Tesla, Apple, Microsoft, Shopify, Robinhood, Netflix, Peloton, Groupon, Carvana, right? But it's a lot of other companies that are smaller, small mom and pop businesses that are simply pushed into, getting ready to bear a storm, right? To weather a storm. But California is a really special place because things are getting very expensive in California, but things are no longer just California that are expensive. It's everywhere that's getting, to that point where it's very, very expensive to simply just live and afford basic necessities. But what we're seeing in California is a major pullback on home sales. And I believe this is going to be a signal. This is going to be a very, very big signal to investors, to property owners, to home sellers as to what's to come. California housing market pukes as sales collapse. San Diego County down 41%. Prices begin to swoon. It's peak home buying season in California, but sky-high home prices, holy moly mortgage rates, the collapse of cryptos, the vanishing DeFis, and the implosion of tech startups, SPACs and IPOs, all of which are crucial to the wealth or perceived wealth of many Californians, pulled the rug out from under California's splendid housing market. Sales volume of single-family houses in California plunged by 14% from June, seasonally adjusted, and 31% from a year ago, the 13th month in a row of year-over-year declines according to the California Association of Realtors. Sales volume of condos plunged 18% in July from June, and 36% from a year ago. Prices eventually will follow. if there is less sales happening, then ultimately what happens is homes sit on the market longer. And if you're a home seller and you want to sell your property and you have a lot of competition in the neighborhood, the only way you're going to be able to complete that sale is likely being priced at a point to where you're more attractive to the limited amount of buyers that are available, meaning it's going to be a race to the bottom for home sellers. Right? So prices eventually will follow. The median price of single-family houses dropped 3.5% in July from June, down from the second month in a row, slashing the year-over-year price gain to just 2.8%. The median price of condos dropped 2.3% down for the third month in a row, whitting down the year-over-year gain to 7.5%. San Francisco and Silicon Valley led with the decline. Sales volume of homes and condos in the entire San Francisco Bay Area has collapsed 37% from a year ago. Prices have started to follow volume. Year over year, the median price of houses across the Bay Area was down for the first time since the lockdown in May of 2020. Year over year, it was down in 3 of the 5 big counties. In that covers San Francisco, Silicon Valley, and part of the East Bay, led by San Francisco, where the median price was down 8.2% year over year. We'll get to the charts in a moment. Southern California is behind, but catching up. Sales volume of housing plunged by 20% from June and by 37% from a year ago. In San Diego, sales volumes collapsed by 21% in July from June and by 41% year over year. In Orange County, sales volume collapsed by 39% year over year. In LA County, down 32%. Prices eventually follow volume. Even in Southern California, in the counties of San Diego and Orange, the median price dropped for the third month in a row. In Los Angeles County, the median home price had peaked in September 2021 and has been on a wild ride up and down. But in July, it fell. But Los Angeles County, they say peaked in September 2021. I sold my house in California when everyone thought it was only just going to go up, and I sold mine in late August. Right, so right at the absolute peak, I ended up selling. And, a lot of people said that I was off base by saying that the housing market is ripe for a big correction. Now it looks quite obvious that we are stepping into a period in which home values are at least going to stabilize. At least going to stabilize in the short term. But I believe in the mid to long term, next 6 months, next year, we're going to really start to see home values really start to fall. This is going to be a huge, huge opportunity for the smart and savvy real estate investor, the renter right now that wants to buy a home, but they've just been, getting beat up by cash offers and people that are just buying properties with no contingencies, just going all in, waiving inspection and loan contingencies, because they're not getting a loan, waiving appraisal contingencies, they're just running out there and buying. This is all going to change because the people that have cash in these types of markets where things change, they're much more careful about how they invest that cash because they want the biggest return because they know that cash is more rare. And home sellers want that fast closing. And so because of that, this is going to be a big opportunity, I think, for all people, all walks of life that want to get into the real estate market. I think that opportunity is going to be coming very, very soon. What do you think about this entire situation? Where do you see the housing market going? Do you think we're stepping into a situation in which we're going to see a big opportunity? Drop your comments below. Let's talk about it. Subscribe here. Subscribe to my second channel as well, which is going to be an interactive call-in show. I'm going to post my first video there in the next 24 hours. I'm going to probably film it today and post it tomorrow. But be sure to go subscribe over there down below. And also, if you need help fixing your credit, you want to buy real estate, but you want to make sure you're going to get the best mortgage. You want to get the best loan. You need good credit for that. We can help you at cashnow.video. You want to learn about real estate and real estate investing? Cashnow.video. You want to grow an online business? You want to start on YouTube? Cashnow.video. I'll catch you guys in the next one.